Hey, good evening. It is your boy Trader Status Quo back at it again. It is June 3rd, 2024, 6:47 p.m. Today is a very special day. You know why? Because I'm here to help you make money. Today, I will be showing you how to make $1,300 per month selling cover calls. That's right. I'll be helping you generate passive income monthly selling insurance contracts on shares that you own, that you love to own. So without further ado, let's get started. As always, I love to always obviously show my personal financial disclaimer. I do not provide personal investment advice, nor am I a licensed investment advisor. So I will not and cannot be held liable for anything that you see here today as a result of your trading actions. So with that being said, let's get started. So what exactly is a covered call? A covered call is an options trading strategy where you sell a call option. So you're not a buyer of a call, you're actually selling a call option, which is called a covered call, on a stock or ETF. ETF, for those that do not know, it stands for an exchange traded fund, a security that you own. So you receive a credit, i.e., a premium, for the value of the options premium when selling a call option. So when you sell a call option, you're selling someone the right, but not the obligation to buy 100 shares of a company from you at a certain price. And that price is called the strike price before a certain date, which is called the expiration date. Said, generally speaking, I like to just tell people from a macro perspective, you should sell a covered call. It is generally flat or somewhat bearish, right? So after a big run up on a company stock, if you think, listen, the company's way overbought, when Tesla ran up to what, $300-400 in 1 year, a lot of people sold cover calls out of the money to collect and really just cap in those gains by collecting premium, because the probability that the stock will keep rising is low, but the probability that the stock will stay flat or go down or kind of just lean over time is high. So what they'll do is they'll sell covered calls against their underlying securities. So that's what I did, and I'll show you today with Robinhood how I did that with ticker HOOD. So that being said, this is one of my favorite, probably my favorite stock that I actually love to trade on today because I believe in the growth. They did over $600 million last quarter, which is really exciting. They're actually also profitable. I believe they made over, I believe close to $100 million, give or take. But let me show you exactly how I made $1,300 per month with Robinhood. So as you see here, this is my Robinhood position. Let me just zoom in a little bit here. I have about over a little bit over $13,000 of Robinhood shares. As you guys can see here, I'm up almost 20% on my position. I've made over $2,000 in Robinhood. But this isn't where the fun is, guys. This is just on my underlying shares that I own. The fun is down here in the options. So as you guys see here, I have 4 different trading strategies, but for today, we'll focus on the calls. So you guys see here, Hood, $22 strike price, call option. I sold 4 contracts expiring June 14th. I'll quickly give you an overview of that trade. And then I decided actually today during a run up to sell another contract at a $22.50 strike price. As you guys see here, I'm up about almost $400 in the last couple of days. But let's really jump in quickly to my contract. So as you guys see here, the contract, again, now it's only worth $86, but I did sell it when it ran up. And also, I'll tell you guys why I sold it when it ran up in a little bit. But basically, I received $1.34 per share. Remember, each contract is 100 shares. So I received $134 per contract, and I sold 4 contracts. I sold it on, this is very important. I sold it about, let's say, actually last week, late last week, so May 30th. And I want to show you guys something real quick. And this is really important for later. I sold it with the implied volatility, meaning it basically shows you how volatile the kind of options contract is, whether it's expensive or cheap. I sold it at a 78% volatility. And I just want you to keep that number in mind for later because that's an important figure. We'll talk about why that figure is important, but also the Greeks here matter as well. I won't go into too much details today, but just know the delta here, I sold it at a 0.43 delta. So that means that there's a 43% chance that it will be in the money, and that's important for later. But really quickly, just keeping it high level, as you guys can see here, as long as the stock is below $22 by June 14th, I'll have realized, looks like here, $535. And this is on my $22 strike contracts. So this is a really exciting time because Robinhood, again, it ran up, and I'll go down here. It ran up this morning actually to about almost, believe over $22. So I sold a contract this morning for $127, but I only sell when it runs up, right? Because the probability of it keep running up is slim to none. These are pretty volatile stocks, right? So you guys see here on May 30th, I sold another contract. I collected $144. So it looks like I also sold another contract for $129 and $139. Again, Robinhood has a lot of upside. And this is the $22 strike that I sold. And then I also sold a $22.50 strike today. It looks like I'm already up, 38%. I collected $115 in credit. And I sold that today, like I said. The implied volatility, again, this is a very important figure. It's about 80%. And so I want you to keep that number in your mind in a couple minutes. And the Greeks on that is, I just want you to focus on the delta for now. We won't get into too much of the other kind of more, complex trading Greeks, but focus on this number right here. The delta is 0.38. So as long as the share price is below 22.50 by June 14th, I will have collected the full $115. So let's go back to the trading example here of exactly what it means and what are the potential outcomes of this trade and how exactly I made $1,300 potentially. So again, this is very important. I sold two contracts, pretty much one on May 30th and another on June 3rd. Again, I sold four contracts for the 22 strike. I got paid $134 per contract for a total of $536. And then I sold another contract today because it ran up like 6% this morning, and I capitalized on that. And I got $125 in premium. Total amount is $661. So there are three outcomes of what could happen by June 14th, so next Friday, right? So outcome number one, which is the outcome that I'm banking on for this trade, is that the price of Robinhood will be at or below $22 by June 14th, which means I'll have collected about $661 in 2 weeks. So if you extrapolate that over a month or 4 weeks, that's about a little bit over $1,300 in 1 month. Well, you're probably like, well, what if it keeps running way past $22? That's fine, because in outcome two, the best thing to do, because I'm a long-term investor in Robinhood, I'm actually going to roll over my position to a higher strike price and push that out to a later expiration date. If you want to learn more about how to roll over a position, if you want to see a live trade on that, let me know in the comments below. Outcome number three is that it also expires above $22, above June 14th. And I may say, to hell with it. I'm happy that I've collected $1,600 plus my premium of $536. And I'm happy with my $2,000 that I made in, a couple months. That's possible. But again, I'm a long-term investor, so I'm going to defer to option one or option two. So that being said, just to wrap it up here for today, what are some ways of winning your covered call trade? You should only sell a covered call at strike prices above your cost basis. I cannot stress that enough. I've seen so many content creators out there, finance gurus, that just pick an arbitrary strike price, pick an arbitrary expiration date without any context on how to win, right? If your strike price is above your cost basis, you're always going to win, because even if your option trade gets exercised at that strike price, let's say it shoots right past it, you'll win because the underlying your cost basis, if it's lower than your strike price, you're always going to collect the spread of your cost basis and your strike price plus the premium that you paid, right? So that's like, even if you get exercise, you're going to win on the difference between how much you bought those shares for less whatever the difference is in the strike price, right? So that's very important. You should only sell covered calls during a flat or bearish market, because if it's a bull market, the probability of your covered calls getting exercised is very, very high, right? Because it'll always run past your strike price. You should always sell calls on strong green days. I personally like to choose 4 to 7% for Hood, because again, you are taking advantage of implied volatility. So what is implied volatility, you ask? And that's actually in the next row here. I always like to sell contracts when the implied volatility is greater than 6%. And just so you guys know, for those that do not know, implied volatility is a measure of how cheap or expensive the underlying value of an options contract is. So generally speaking, anything less than 50% is cheap. Anything less than anything greater than 50% is very expensive. So I like to be the seller of contracts when those underlying options premium is expensive, right? Because then you're collecting more cash. And then I like to target a delta of about 0.35 to 0.50. Again, this is really for those that are really new here. A delta of 0.35 means that pretty much there's a 35% chance that your contract will get exercised, so you probably have to roll it out. If you want to be safer, you should probably look at a delta of 0.1 to 0.2, so less risk for your contract being exercised. And then lastly, you only should sell out of the money covered calls at a price you are comfortable with selling, so above your cost basis. So that being said, if you're wondering what my current trading strategy is with Hood, I personally will be buying a ton more shares below $20, and I'll be selling more covered call contracts above $22. So if you like the content today, please like, share, and subscribe. Let me know what you think in the comments below. Thank you for your time. Peace.